Welcome to Bright Ideas. My name is Brian, and if you're watching this video, you must be interested in learning about stock options. So a little disclaimer, I'm not a professional investor, stockbroker, financial advisor, so definitely do your research. Nothing in this video should be considered as financial advice. Definitely consult an actual professional financial advisor for your investments. And of course, also number one rule of investing, never invest any money that you can't afford to lose. So, what is a stock option? A stock option is a contract for the right to purchase or sell a stock at a specific price. A call option, that is a contract for the right to purchase a stock at a specific price. When the stock price goes above that call option's strike price, or that agreed price, that call option is now considered in the money and its value goes up. When a call option, or I should say when any option is out of the money, its value goes down. A put option, that's going to be a contract for the right to sell a stock at a specific price. And of course, in that case, as the stock price goes down, that means your put option value goes up. So let's give an example. So let's say that you purchase a share of stock A. Stock A is valued at $100 a share. So your investment's $100 to get in. The stock goes up by $5. So now you have $105. It's a 5% return, right? Great. Well, let's use that example with options. So let's say you buy a call option for that same stock with a $100 strike price. Now an option contract, that's going to be typically, it's going to represent 100 shares of stock. So let's say you buy that call option at the $100 strike price at $1 per share. So that means you're going to have a $100 investment to get in. That's $1 times the 100 shares the contract represents. And then let's say in that same circumstance, so let's say the stock goes up by $5. So now your $100 investment is going to be worth $600. That's the initial $100 value that you invested in the first place, plus an additional $500, which is that $5 gain times the 100 shares that contract represents. That's a 500% return, which is fantastic. So now a put option. Put option is going to be kind of the same thing, but on the other side of it, right? So put option is going to be the contract for the right to sell a stock at a specific price. Let's say you have that stock A with that $100 value. Let's say the value goes down by $5. So that's going to be a $100 investment. And if it goes down to $95, that means you now have $600. Again, a 500% return, which is phenomenal. All right, so what's the difference between buying stock and buying a stock option? Well, the main differences are going to be the equity, expiration, and the risk. So with a share of stock, you own that share of stock. It doesn't expire. You own that piece of the company. You have that forever unless you sell that share of stock or unless the company goes out of business. Stock options, that's not the case. So with the stock option, you don't actually own any equity in the company. You don't own any shares of stock. It's just the right to purchase shares of stock at a specific price. And of course, that contract, that right, has an expiration date. So if your option is not in the money by the expiration date, it's essentially worthless. With that being said, it is a higher risk, right? So with a stock, you do have that underlying value of the stock. The value of the stock might go up or down, but you have that value. It won't go away unless the value of the stock goes down. With the stock option, it's worth zero once you're at expiration unless you're in the money. Great question. Do you have to buy the shares, right? So you have this contract for the right to purchase or sell, shares of stock at a specific price. Good news. This is actually called purchasing stock options naked. Just meaning that you're not intending on purchasing or selling the underlying shares. Now, with that being said, definitely do your research and make sure you know how your brokerage handles expired options. They may sell the option, they may exercise the option. That's why it's very important to know how they handle that. If they do happen to exercise the option, then that can be a little more dangerous because it means they're actually going to purchase those 100 shares of stock. So that means they'll look to your account, at expiration, if your option is out of the money, then you don't have to worry about it. It's worthless and it's just going to expire and you're fine. But if it's in the money, if you made money, then that's when you actually have to worry about it, right? So that means that at expiration, they're going to look to your account to purchase those 100 shares at that strike price, which of course is still a gain, which is great. Moral of that story, you want to make sure you do sell the option contract before expiration if you're trying to buy the options naked, essentially. Also with put options. On the same note, at expiration, if you're in the money, that means you may have negative 100 shares in your account, which now that means you owe the brokerage essentially 100 shares of that stock. Now, if you're in the money, that may not be a big deal because you've made money, right? You're fine. But if the stock price changes, if the price of the stock goes up, that means you could have to buy it at that higher price to pay back those shares, which could make you lose a lot of money. So again, it goes back to that moral of the story with options. Sell them before they expire. Then you won't have to worry about that. Well, that's pretty much it. Yeah, thank you so much for watching. If you like the video, please hit the like button and subscribe to the channel. Also, there is a link to my Webull referral below. If you would like to open up an account with them, you do get 2 free stocks. So yeah, definitely check that out, and thank you so much for tuning in.